Join us at ACE Academy, the Exceptional Advisor Conference, taking place in San Diego, April 30th through May 3rd. Look forward to over 1,200 prestigious financial advisors like yourself who are looking for the newest strategies, insights, and tools to help better serve their clients. Don't wait too long to register. The early bird deadline is rapidly approaching on April 1st. We wouldn't want you to miss out on the savings. This conference will be jam-packed with more than 50 speakers, 35 sessions, 5 general sessions, and various networking events and receptions. Register today at investmentsinwealth.org/conferences.
We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. So my guest today is Clare Flynn Levy, the founder and CEO of Essentia Analytics. Clare, welcome.
Thanks for having me.
It's a pleasure. Before we get going, for the benefit of our listeners who may not be familiar with you and your work and your background, do you mind giving us a brief overview?
Sure. So I am a former fund manager, equity portfolio manager. Originally ran a balanced pension fund money for Deutsche Asset Management out of London, and then ran a long-short European tech fund also out of London. Became a hedge fund manager, and got to a point in, I guess, early 2000s that was not dissimilar to where we are now in the market or where we were earlier in 2022, where fundamentals weren't necessarily the driver of prices. And I was really trying to understand, given the 24 hours that I have in a day, what would be the best use of my time? What I had been doing was just getting me negative performance. So, all right, I'm prepared to change it up. But could somebody just tell me, what is it that I'm doing that's helping, and what is it that I'm doing that's hurting? And, the big picture is what I'm doing is making decisions, right? So which types of decisions do I tend to get right, and which types of decisions do I tend to get wrong, and in which context? If you can tell me that, I'll spend all my energy just doing the ones that I get right, or that I have the highest probability of getting right. But nobody could tell me that. And so in the end, to me, it became clear that without that information, we shouldn't really be surprised that active equity fund managers don't outperform the index, because they're chasing their tail. They're looking at performance as a measure of skill, when hopefully it's a function of skill, but it's also a function of luck. We know that. So, if you're using that as your feedback loop on whether you're making good decisions or not, you're fooling yourself one way or the other. And so you should get a random result. Like, that's what should happen, and it is what happens. But if you did know which types of decisions you were good at and in which circumstances, and did spend all of your time just doing on this, you should be able to do better than chance, and you should be able to outperform. But you would need to be tracking that and have access to that information. And so I decided, we've got to start this company this is the underlying question that every fund manager should be asking themselves, whether they, their ego is permitting that or not. Logically, this is the question that they should want to answer. And this is the question that allocators of capital to fund managers should care about answering as well. So that's really what we do at Essentia. We're a software company that has a very high touch level of service and consulting around what we do, because it's about using technology to analyze somebody's historical investment decision making, and then holding up a mirror to them and showing them, this is you in the mirror. This is what you're doing well. This is what you're doing that is hurting. Let's discuss. And now let's discuss how we're going to help you not do that so much in the future. And we have a software feature called Nudges, which is all about sort of tapping on the shoulder at the, it's a much more subtle than the type of nudge that Richard Thaler and Cass Sunstein wrote about in their book. But which is about sort of like gently guiding people in a certain direction. This is like, heads up, you need to look at this position. You said the next time you were in this situation, you wanted me to ask you 3 questions. Would you be a buyer of this stock today? Have you, done a tear down with the analyst or, whatever? You choose what the questions are. But the point is that technology is reminding you to focus on a thing that in the past you haven't done well, or you've, got yourself into trouble, so that you can just sort of trigger some system 2 thinking in the Daniel Kahneman parlance. System 1 is like not doing anything about it and focusing on something else. System 2 brain needs to look at this stock right now and think hard about it. And then you might or might not make a good decision, but we think the odds that you will are higher if you've thought about it more carefully.
Yeah.
And then we track whether you do make better decisions. And the answer is yes. People do make better decisions, not surprisingly. If you prompt anybody in that moment and you don't do it in a way that makes them mad, they would, more often than not, they'll make a better decision. So that's what we do. It's a very long story, but
no, it's fascinating. I think we should do a deeper dive and have you sort of explain how the technology works. Is it AI based? Is it and how do you prove that someone's made a good decision, or that will make a good decision? I guess it's kind of an interesting new brave world that you're describing here.
Well, it's sort of the next logical step in the search for, how do you separate luck from skill in investing? And, to start with, we had performance attribution that's looking at performance and saying, well, here's how you perform relative to an index. And now let's pick apart why did that index perform well, and then compare it with you. And then we can see whether you're adding any value, and therefore whether you're skilled, which is, a way to do it mathematically. It is a way. It's not very helpful to the fund manager, because what are you supposed to do with that information once you have it? It's like, yeah, my stock picking in Argentina was bad last quarter. Like, it doesn't say anything about what should happen next quarter. Whereas the way we're coming at it, it's like an additional lens that's saying, well, what decisions did the person actually make? Like, take a bottom-up approach to analyzing this rather than the top-down approach, or in addition to the top-down approach, and say, what decisions did this person make? What do the good decisions have in common, and what do the bad decisions have in common? So it is where the industry is going, in the same way that Moneyball is where the sports industry have gone. It's like there isn't a sport that hasn't been transformed by that. Even hockey, probably. We were just talking about hockey.
Hockey is, every sport is looking for value, I think, in terms of bright players and undiscovered talent and whatever. So a question, does it work both in a team manager approach as well as a solo manager fund?
It works differently, I would say, in those situations. The easiest way in a team managed approach is if you have very clear ownership of different ideas by different people, and if they run sector sleeves, a lot of large asset managers will have that sort of a setup where you're an analyst maybe and you're running a sleeve that's only retail stocks or only, whatever. That's the easiest way to be able to do that, because you wouldn't want different, there's diversity on the team, and there's different people have different patterns. It's like, call them dance moves. Like when you're buying a stock, some people tend to wade slowly in, and some people just are in and they can't. And it's like, instead of wading into the water, they cannonball it.
Yeah.
There's not a right answer, but if you put all of that together, you're not necessarily going to see that this guy does this and this guy does that, this woman does that. So you want to be able to separate them if you can, but I've also seen it work well with teams where you have no separation, because maybe the idea ownership is a consensus thing, or maybe it's more like everyone's a generalist and they just have ideas across sectors. In those cases, it can be really interesting to analyze you could ask people when they enter a new name, a new stock in the portfolio, we send a nudge that says, so let me ask you 3 questions about this stock. And one of them is potentially, and has been for some of these clients, was this a consensus, like a unanimous decision? Was it a highly contentious decision, or was it, mixed? And it's amazing what you find sometimes. I mean, for the one I'm thinking of, the answer was their highly contentious decisions are where all the alpha was coming from. And so the takeaway was like, all right, it doesn't feel particularly nice to be in an investment meeting where there's highly contentious decision making going on. Right. But actually, you're onto something potentially. Yeah. Because in the past, those have been all your best ideas.
Yeah.
It's not necessarily all coming from one person either,
Yeah. So just a question: when you think about, we've had a world in which there are star managers, and I'm sure you've had a chance to think about whether it's luck or skill or not. And do you find that maybe some of these star managers, Peter Lynch, for instance, just had better decision making than luck, or was it a combination of luck and good decision making?
We'll never know for sure because we don't have his data. But I suspect, his whole thing was like finding 10 baggers, and, you just have to have a few really, really good ideas. And so I suspect that if we had his data, we would find that we look at these 2 stats, like sort of goes back, if you think of baseball stats, your hit rate is, what percentage of the time does your idea generate excess return or alpha or absolute P&L if you're an absolute return manager. So what percent of the time do you get it right versus, out of the total times that you try? You want to be over 50%. But you can get it wrong a lot, as long as when you get it right, you get it super right. And when you get it wrong, you only get it a little bit wrong. So it's not quite the same as a slugging statistic in baseball because you can get it very wrong and lose all your money in fund manager, right? And so it's the payoff, we call it payoff, is the average P&L of your average winning position divided by the P&L of your average losing position. And that could be the relative P&L or the absolute P&L, but the point is, are your winners winning more than your losers are losing? And so you want that number to be over 100%. And I suspect Peter Lynch, the range that we see across equity fund managers in hit rate, it's quite tight. At the very low end, you see maybe 40%. That happens sometimes. And somebody with that low of a hit rate, it's not likely that they're generating positive alpha, but it's not impossible because they have a really high payoff. It can make up for, you could have like a scattergun approach and get a lot wrong, but as long as you're really good at nipping it in the bud every time, you could get away with it. But so 40 at the low end, high end is like 56%. So like a, relatively tight band. Whereas with payoff, you can have, we did a study on this recently in it's called the Behavioral Alpha Benchmark, and we looked at 90 different portfolios, all the different types of decision that they're making over rolling in the past 3 years, I think, ending at the end of 2022. And so if the hit rate range was like 40 to 56 or 57, the payoff range was, I think it was like 40 to 200, meaning at least one person was getting their winning decisions twice as right as their losing decisions were wrong. And at least one person was getting it wrong. Like they're I don't even know how the maths of that works out, but the wrong decisions were significantly worse than the right decisions were right. So that's where a fund manager can really, make or break. You don't have that much to work with hit rate wise, actually. It's on payoff. And I think Peter Lynch would have been really good at payoff. Yeah. His hit rate would have been, I don't know, hopefully over 50%, but who knows? But his payoff, because he was all about you just have to have like one good idea in a decade type of thing, it probably would have been very high. But ideally, you want more than one.
Right. So what's the fund industry's reception to what you're doing here? It seems like they would be eager to have their managers make better decisions.
Yeah, well, we've been going now for almost 10 years. And we've always been coming at this from a fund manager's point of view, meaning, this hasn't been about analyzing managers and judging managers. There's lots of things out there that do that. And as a former manager myself, I think it's all well and good, but it's not actually helpful. It's just narrative. Yeah. It's explaining what happened, but if you show it to the manager, and the manager is a continuous improver, hopefully, there's not that much you could directly put into action based on what you've seen in your performance attribution or even your risk analysis. Yeah. I mean, a little bit, but so the idea was always, how do you help a manager make measurably better decisions? Yeah. And some managers are really up for that. And, they tend to be people that are wearing a Fitbit or a Garmin watch, or they're run triathlons, or, it's like that type of person. They're often like a CFA that's just very up for being intellectually honest with themselves. And those are the early adopters, and those are the people that we've been working with, since we started. And it's slowly spread within larger firms. So a lot of our we work with 30 different firms around the world, and they're very big names that you definitely would have heard of. Yep. But not every manager in that firm. There are a lot of managers that are not up for this. Yeah. They just don't want to know, because, that's an emotional decision being made right there. Your monkey brain says, oh, that sounds like the risk is on the downside for me personally. Yeah. What if it says something bad about me? And so the sort of the wall goes up, and you sort of reject the idea. Some people can push through that and understand that, yeah, I get it. It's like, it doesn't feel good to go get your body fat pinched at the gym either, but you got to have a starting place. Yeah. So
I don't want to have Chat GPT write better than me, quite frankly, either, right? But this is about helping you. It's not about beating you up. So either you want to be the best fund manager you can be, or you don't. Yeah. And that, as a narrative and as a sort of thing, I'd say only in the last 12 months have we been intentionally talking to big asset allocators, pension consultants, pension funds, endowments, and, people like that about this, and saying, have you asked your managers what it is that they do to continuously improve, and what they've done in the last 12 months to improve their process? Yeah. Because if they say, well, we have an offsite once a year, time's moved on. Like, that's not a good enough answer. So we started talking to them about that, and now actually are just getting ready to launch a product that is for allocators who, with the permission of the manager, want to be able to see a certain amount of this information about the manager's skill. And not everything. I mean, it's a lot. Like, it's like seeing every medical test, it's like, that would be too much information to share. But a little, the high level stuff, most of the managers I talk to are happy to share that with their investors. And investors are saying, oh, well, in that case, I would like to see that. And so it's starting to gather a lot of momentum as a thing in the equity fund management world. So I could certainly see financial advisors who are using 40 Act funds wanting to know, right, the degree to which their managers are making good decisions, and have that drive their decisions around whether or not to use a fund or not in their client's portfolio.
Exactly. And, you're buying, when you're buying one of these funds, you're buying if nothing else, you're buying a track record, right? And then get ready to be disappointed if the past is not predictive of the future necessarily, performance-wise. It does say that on the bottom of the ad, but okay. That's how people tend to to make these decisions, but you're also hopefully doing some due diligence about the manager themselves and the firm and all of that. And I think more and more it's fair for potential buyers of a fund to be asking questions about, do you know what you're good at and where you need to improve? Like, have you done that exercise? What have you learned? What have you put to work out of that? And if they haven't, why not? Why would, if you knew you could, and it's not that expensive, like you could do it, why would you not do that? And if they're like, oh, I don't need that because I'm so great, or some other answer that I don't know what it would be, it's sort of like, what else do you need to know about this person? Like, I wouldn't trust my money. When I first moved over here, I lived in England for 25 years, and I moved back to the U.S. in 2018. And I grew up in the U.S., but I'd never been an adult in the U.S. And suddenly, here I was, the mother and wife, and, I'd had wealth management needs. And so I had to choose I could go full on robo, I could go wirehouse, I could go boutique. Like, there's so many different options. And I did look at a lot, I'm fascinated by all of this anyway. So I looked at a lot of different options, but what I decided in the end was to go with a boutique called Brown Advisory out of Baltimore, who I know them very well because they work with us at Essentia, but it's not why I chose them. I know that they actually do try harder, and they really practice what they preach on. Their whole thing is about thoughtful investing. They actually do that. And I feel like in the financial industry, if in this day and age, if you can just be to people what you say you are, and earn their trust, and of course you need to be able to fulfill the obligations around services and all of that, but it's like the underlying motivation needs to be, we want to be the best investors we can be, not we want to make the most money we possibly can. Whereas 20 years ago, that wasn't how it worked. It was the other way around.
So it's funny that we were talking about hockey before we started recording, and the coach of my hockey team, his motto is try harder.
There you go. I mean, it works. That's the thing. And people like the people that are trying harder.
Yeah.
So
do you want to turn our attention to behavioral biases and FAs and what they can do to manage and mitigate their biases, and then in turn what they can do to help their clients with whatever biases they may have?
Sure. Well, I mean,
where to begin?
The first thing is, for FAs, take note. It's not just your clients. A lot of, I'm not that close to the ground when it comes to the wealth management side, but I do notice that behavioral coaching and behavioral stuff is, increasingly popular, and it's a way to differentiate in the market. And if you're presented as an end investor with two potential FAs, and one of them can tell you stuff about your own behavior and help you, get out of your own way, that's interesting, value added. But the focus tends to be on the end investor's behavior, not on the FA's behavior. And there's no reason for the FA to believe that they're actually much less biased than anyone else, including the fund managers I work with, are the people you would consider to be the very, very top investors in the world. Even them, we're all biased. And so be prepared to look in the mirror would be the first tip. Now, to do this sort of work, you need to be tracking decisions. You can do that by just starting with trading decisions. And it depends on how you operate, but if you're running discretionary portfolios, it's, much easier to do than if you're not, because it's not necessarily your decisions if you're not. But even if you don't have access to trade data that says you decided to, buy this and sell that on these dates and so on, you can at least be tracking the asset allocation decisions that you're making. They might not make that many of them over time, but, put them in a spreadsheet in a uniform way. It's not text, it's structured data, ideally. When did you make the decision? Why? Who was involved, or whatever the relevant data points are. And if all you did was just start tracking that, if you haven't already been doing it, and do that for like a year, you won't have necessarily statistically significant analysis come out the other end if you're not making a lot of decisions, but you'll still find something interesting. So, be curious enough to track your decisions so that you can do analysis. Yeah. And writing it in your journal, it's a good practice to journal, but unfortunately, going back and making sense of it and finding patterns is a lot less precise when it's written in a notebook than it is when it's data in a spreadsheet. You can just analyze it. So that's another suggestion. But the things that we see, certainly amongst fund manager clients, as the most common biases, there's actually one that is to do with the endowment effect. Okay. So, as a professional investor, you come up with a thesis, or, you make an investment based on a story, and here's the story of why we're in this position. And then the position, maybe it goes really well. Now here's the story of why this is our biggest winner and it's our big sort of success story. And you love telling this story. And then after a while, you wake up, it sort of stops being quite so sexy, but, it's still your family at this point. And then one day you wake up and it's like a disaster, and it's had a big profits warning, and it's like, you've lost everything that you made. And now you feel like a total idiot because it's gone from being a big winner to being a loser. And, we call that the round trip. The round trip is the worst. And not everybody has a big problem with round trippers, but a lot of people do. And it's often about, you just sort of, you get soft on things that you've put a lot of work into, whether it's a sunk costs bias type of situation. You've worked so hard on this idea and you put too much energy into go back now. Or it's just, I think this thing is the best thing for sliced bread because I already have it in my portfolio, and the market is telling you that it doesn't agree with you about that. And that's really your endowment effect thing. But if you can, and this isn't necessarily easy to do manually, like we do this with our clients because we have a whole, analytic based entirely on this concept of the alpha life cycle. But what it does is it looks at every stock you've ever held in your portfolio, and it looks at like, how did the excess return, if you're doing it relative, or just the P&L if you're not, how did that accumulate over the life of the episode? We call it the sort of that chapter in the book. Did it make all the money in the beginning and then nothing after that? That's one thing that sometimes happens. Sometimes people make a lot of money in the beginning and then it goes into loss. Sometimes you get that round trip that, I talked about. Sometimes it just goes like up in a straight line and then you get out, and like that would be the ideal for every position, if only you could do that. But if you could look at all of your positions over as long as you can, and, for what we're doing mathematically, you need to have had a lot of positions. So this isn't for somebody who's, got a very concentrated portfolio that they never trade. But if you do it all together in the aggregate, you'll find that there's a point where if a stock has been winning for you, there's like a point where it's time to ask yourself some additional questions and force that system to thinking. And it might be a different point for losing stocks. Usually it's sooner for losing stocks. And it's not saying let's play all of your positions. If the point was 6 months in, let's say 6 months into your positions, historically would have been a good time to ask yourself some extra questions about them, just to like retest the thesis and, make sure you can recommit to it. If it's not saying therefore you have to sell all stocks that are 6 months old, it's just saying like, do a little extra deliberate thinking, and we think you'll probably end up making a better decision. And that actually works. As I say, it is, it's pretty interesting though, that it's because you can't no one's keeping track of how stale a position is in your portfolio, or like whether you got all the juice out of it. You've got other things to do, and you don't necessarily focus on that. So I guess what can an FA take away from that? It's something about keeping an eye out for positions that you may have fallen in love with, like maybe you build into your process a devil's advocate step, or I see sometimes people have a thing where you have a partner who picks up your stock. You stop being responsible for that stock, now moves to somebody else. That person has to come at it from a clean sheet of paper. And that just like keeps the thinking fresh, because it's no good holding on, being long-term, if long-term leads to death.
Right.
There is such a thing as too long-term. We're all supposed to be long-term investors, and yet, there is such a thing as too long-term. So that's another bias, I think, that is worth thinking about. And then, I was just going to say one other one, which is, I guess, to do with putting in little placeholder positions, like things that are not, it depends on what you're selling to your client, obviously, and different people are buying different products. But if when I look at an actively run equity fund, index hugging, nobody particularly wants anymore, right? So it's like, if you want to buy an index, but you don't need an active fund manager who is getting very close to the index. Like, what's the point? And yet there's still quite a lot of firms that do that.
Yeah.
And there's still quite a lot of people who, on the one hand, you want a diversified portfolio. On the other hand, if you have a few good ideas that you've sized up and then everything else is a tiny little position, you may find that the tiny little positions are like death by 1,000 cuts. It's like these things bleed, and if you put them all together, it's a big pool of blood. I've watched people completely ruin excellent alpha generation by bleeding away on stuff that they thought they were doing for risk management reasons. And it's like, you're making it worse. That's not helping anything. So that's another one where if it's relevant to any FAs listening, it's about conviction and understanding that having low conviction ideas in the portfolio is actually, it might be generated by a bias toward, like a fear of future regret for not having had exposure to that thing. But if you're only going to have a small exposure, it's probably not going to do anything for you anyway, so it's worth, raising the bar for what you require for something to end up in the portfolio, and only having, proper bets.
Yeah. So two things come to mind. One is there was a study done by Vanguard that said that an advisor who has an understanding of behavioral biases can maybe add 150 or so basis points to performance. And then Cerulli had done a study that looked at the most significant biases affecting client investment decisions. They were in order: recency bias, loss aversion, confirmation bias, home bias, anchoring, and status quo or inertia. Any thoughts about the need of advisors to become really familiar with the biases that their clients are likely to have, and and recognize them and steer them away from those biases, like recency bias, for instance?
I think it's really helpful for us all to be educated about these things. So to the extent that the advisor can educate themselves and then spread the wealth and share that with their clients and show their clients, what it is that they're especially susceptible to. I know there are a few products out there that exist and, do a little like a risk assessment, but it's a behavioral assessment. And they tell you you're prone to this sort of bias, which leads to this sort of behavior. You're, more likely to take profits too early, maybe, or whatever. I'm of course, very interested in these things, and I did one of them not that long ago, and my husband also did it. And I think there's a really interesting opportunity there to help couples, as clients understand, because in the background the couple is potentially arguing about, I think we should do this, no, I think we should do this, and they probably don't think in the exact same way about money, or be they may not be prone to the exact same biases. And so when you go through it and you both have your report and then you trade them and you're like, oh, interesting, okay. Now the next step after that is, okay, so what are we going to do differently when the next time this comes up? And there's a proposed change to be made to our portfolio, knowing now that, I tend to be like this and you tend to be like that. How are we gonna make a better decision? That part, I don't think I've seen anybody hash out yet. But if I were an advisor, that's what I would be doing, because I think you're doing a massive service to the client. You're helping them get along better with their spouse over money, which, is never a bad thing. And it's that's a unique, I think that would be a valuable service. So there's a lot you can do there. Now, you'll never know whether you're saving them 150 basis points, right?
Right.
I know how much we can measure it at Essentia, because we can see what trades you do on the back of the stuff that we're working with you on. But it's just interesting that it all, even the stuff that we do, it tends to add up to 150 basis points. It's weird. I mean, there's 150 basis points there, and depends if you care about that or not. If you're a professional fund manager, you definitely care about it. If you're a mom and pop, I don't know. If it's 150 basis points avoided loss in a falling market, you probably care.
Yeah. Well, certainly in a world where an advisor might be charging 1% of assets under management, and you have a low interest rate environment and a falling stock market, maybe all that matters.
Then you've more than paid for yourself by helping them do that.
Yeah.
Yeah.
So one last question, and before I ask you to sort of sum up, but as we're now in a world where fintech, artificial intelligence, it is now more the norm than sort of the exception. And I take it that advisors should embrace this brave new world that we're entering, where these tools will become available to help us do our jobs better, manage money better, et cetera.
I mean, if you're not embracing this stuff, then you may... I'm about to be very dramatic, but, at the end of the day, there are some people who don't plan to stay in this occupation for that much longer because of where they are in their life, right? And maybe they plan to retire in a few years or something like that. If that's the case, and you want to keep doing things how you do them, and it's all on paper, and you're like, okay, hopefully you have somebody else in your firm who you're, handing over to when you retire, who is embracing this stuff, because this is just going to be table stakes. It really is what's required, in the same way that it wasn't that long ago to me, but maybe that's me showing my age, when, particularly in England, I had wealth management accounts that sent me a paper statement once a year. Like, literally, they didn't have websites. It wasn't that long ago, actually. And then even they eventually, they had effectively an oligopoly, so they didn't have to compete, but even they eventually have an app and a website where you can get your statements anytime you want them, and things are valued every day. And it's like, there's no world where you're going to last, another decade without embracing these tools.
Right.
So you don't have to, but then don't be sad when you're not playing anymore.
Yeah.
Like Moneyball.
Like Moneyball.
Some people said, oh, that'll never work and I'll never embrace. Okay, where are they now? Not in baseball.
Yeah. I love the Brock Purdy story for San Francisco, right? He was the last drafted player, but among the few quarterbacks that actually had played all 4 seasons, and the 49ers got a good deal there, for at least until he hurt his elbow.
Yeah, well, being able to do it on the team level like that is, and from an ROI perspective on your investments that you're making in different players is very cool.
So we covered a lot of ground. Anything we missed or anything that just bears reemphasizing from your point of view?
Well, there's so much more I'm sure we could say about all of this stuff, but I guess in the end, I would go to a quote from Ray Dalio of Bridgewater, which I don't remember off the top of my head. So,
who's a pretty good decision maker, I understand.
Apparently, he knows what he's doing. But, his whole thing is like radical transparency. And to paraphrase him, he says, there's no bigger problem for humanity than the failure to be willing to look at our own mistakes and just understand what we don't do well. And it's true. It's ego that stands in the way, whether it's your own ego, your client's ego, whatever. We're humans and we have egos. and picking at our wounds is not particularly fun to do. But it doesn't have to be like that. It doesn't have to be a sort of painful process. It can be a fascinating sort of scientific process if it's approached that way. And if you can help your clients learn about themselves in a safe environment where they don't feel judged, I think that's worth a fortune. These things, this is where really authentic relationships are formed. But you got to be prepared to go there in the first place. And it helps a lot to have gone there yourself first. So you can say, well, I did this myself, and here's what I came out with, and here's what I learned that I'm really terrible at, and here's what I'm doing. It's like, okay, so you're not just judging me. You're also telling me that you are fallible too, because you're a human being. And so if the more of us who can just shut down the ego that's telling us we don't need to do this and just be brave, the better off we're all going to be.
Claire, I've so enjoyed the chance to chat with you and have you share your knowledge and wisdom with our listeners. It's greatly appreciated. I hope we get a chance to do it again.
Yeah, it was a lot of fun. Thank you.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.